IBM stock review is the title of today's presentation. If you're somebody that's holding IBM stock or thinking about holding IBM stock, then you'll want to watch this. So we've been shareholders in IBM now for over a decade as part of our dividend growth investing strategy. And we've taken a look at quite a few things the company has been up to over the years. Here are some of the articles that we've written, and I'll link to particular pieces in the description of this video that are relevant to what we're going to talk about today. So there's this old saying that nobody gets fired for buying IBM, the idea being that IBM has been historically so competent and dependable that if you chose to implement a technology solution from IBM or one that they were recommending, that you couldn't go wrong with that. Nobody would question later on that decision. Now, maybe that should be changed to nobody gets fired at IBM, because when you have a company that's been successful for a very long time, they become lazy. And I think this screenshot from one of our pieces pretty much sums it up. You can pause the video and try to understand what's going on here. What it comes down to is wasted advertising dollars. Now, one of the individuals that we've been quite critical over the years as shareholders of, along with lots of other pundits, is their ex-CEO, Ginny Rometty, seen here. And this is a piece, I think, from MIT Technology Review, where she talks about diversity. And you can see this chart on the right. This is the revenue growth for IBM during her tenure. So she talks about having reinvented 50% of IBM's portfolio with a focus on the cloud DEI, which is poison that certainly did the company no favors, AI and quantum computing. Now, we've looked at each of these areas, and one could argue that they only started realizing traction in cloud when they purchased Red Hat, and that was around the time that Ginny departed. Now, she was recently quoted as talking about, and this isn't a new idea, it's a belief that she's held throughout her tenure at IBM, that companies have come to rely on a college degree as a proxy for success. True. And then she says, well, nearly 80% of this disadvantaged group that we're not going to name doesn't have a 4-year college degree. Well, that's not our problem, and it's not IBM's problem. And it's a disservice to all the people out there that busted their asses to get a 4-year degree to lower the bar and, quote unquote, shift to a skills-first approach in order to open the talent pipeline to a broader and more diverse talent pool. Well, Ginny, it's the PhDs that you want to hire, the poor, hungry, determined people who actually do the work and show that they can hustle. And part of that, certainly agree that a 4-year degree doesn't do a lot to teach you skills, but it's a good gateway for people to pass through that shows that they're capable of working hard, working to deadlines, and putting in the time and effort to succeed. Now, Ginny, in this interview here with Lex Friedman, it's excellent. I watched this, and she didn't have an easy task. And I think in the business world, oftentimes you can be very critical of people in emails and in written communication, but when you sit down and talk with them or call them on the phone, it changes. And I think listening to her talk to Lex and be interviewed was quite refreshing, and you can certainly see that she didn't have an easy job, and that perhaps she means well. But what it comes down to is this chart on the right that shows the performance of the S&P 500 against IBM's share price with dividends included. And in April of 2020, shares popped on the news that, I'm not going to butcher this gentleman's name, or maybe I will, Arvind Krishna would take over the reins from Ginny and after leading IBM's acquisition of Red Hat. So here is her tenure marked in orange, and this is simply IBM's revenues that declined all the way until she left, and now they're starting to show some gains again. So IBM's strategy post-Ginny: streamline its business and focus on higher growth areas such as cloud computing and AI. Well, that's what she said she was doing during the 8 years that she worked for IBM. So it's nice to see that's finally, that's continuing, let's say, and finally starting to be realized. And you can see here the investor deck that IBM put out in 2021, around the time that they had their new CEO come on board, is very insightful. It's very clear. It makes a lot of sense. This is a complex business to understand. We're going to try to understand the basics today. Now, the goals here are simple. Optimize the portfolio of businesses for mid-single-digit revenue growth. So that means 5% growth is what they're targeting. At least it's better than the horrible decline that we've seen over the past 8 years. Increased focus and agility to better serve clients, and Ginny talks about that in her interview with Lex, how difficult that is actually to do. And this bit here is quite important to us as dividend growth investors, generating $35 billion of free cash flow over the next 3 years to enable investments, and of course, to keep increasing the dividend that we rely on. So you can see here where they talk about their model for annual growth. Revenue growth, mid-single digits, is free cash flow growth, and this diagram here shows how their incremental debt capacity, they're using debt quite a bit, leveraging debt to boost value, as they say. You can see that the free cash that they have is a ton. This $35 billion or so from free cash flow, another $5 billion in debt that they can play around with, and they're going to use that for shareholder returns. You can see that's the gray part there, dividends or share buybacks, and available for investment to keep growing the business. So what does IBM actually do? Well, they structured their reporting a lot differently when the new CEO came on board, and you can see here from the reading from left to right how they now have 3 main segments: consulting, software, and infrastructure, and the corresponding revenues there in 2020 for each. And they report at a segment level the revenue, so you can see that growth over time. And then they show growth in the sub-segments that you can see here. Now, you'd be quite surprised how many companies rely on IBM's mainframes, for example. They're the backbone of today's global commerce, handling more than 30 billion transactions a day. That's more than the number of daily Google searches. It's including 87% of all credit card transactions, about 8 trillion a year, 29 billion ATM transactions, about 5 billion a day, 4 billion passenger flights a year, and 68% of the world's production workloads at just 6% of total IT costs. These are workhorses, and these numbers were taken from a 2019 piece that we wrote on IBM's new mainframes they had come out with. And for example, Citi uses IBM mainframes to process 150,000 transactions a second. The reason why the mainstream computer remains entrenched in 92 of the top 100 banks in the world is because you can't compete with these machines on cost. So IBM has a long history of offering these workhorse machines to businesses, and whilst they have their tentacles there, selling them other things. Now you can see here their focus on software. So they divested part of their business when they had the new CEO come on board, and when they revised these segments to focus on consulting and software. And you can see here where Red Hat, that acquisition, is driving high teens growth. So the software component that you can see here makes up a major part of their business. It's described here on the right as well in the lighter blue where it says hybrid platform and solutions. That's really where they're focusing on, right? You have Red Hat, automation, data, and AI, and 80% recurring revenue base with strong renewal rates. So they're starting to build their business as a SaaS firm, similar to a SaaS firm. You can see that here in the software segment where they look at performance metrics. You see annual recurring revenues, net retention rate. So they're building that out like a SaaS business. But notice here where they talk about hybrid cloud, and we've highlighted 3 points there where for each of these segments, a key performance metric would be hybrid cloud revenue. Everything is driving towards boosting hybrid cloud. And it's also, we failed to highlight here, you can see there's additional bits under consulting, hybrid cloud platform engagements, and under software, hybrid cloud platform clients. They're pushing all aspects of their business towards cloud growth. Why? Because We just wrote about this several days ago. I'll put a link to this piece in the description of this video. Investing in cloud computing, is there growth left? There's a ton of growth left. This slide here that you can see below is taken from a Google presentation, and it shows how total public cloud services spending is expected to double from $500 billion in 2022 to over $1 trillion in 2026. And IBM hopes to capture some of that with their acquisition of Red Hat that helped put them as a major cloud player, one of the top 5. And we wrote about that here, at what a hybrid cloud is when they talk about hybrid clouds. And you can see here for last year how Red Hat grew 17.5%. That's adjusted what they call constant currency. We'll talk about that in a second. Now, when you look at Red Hat, that chart on the left, that's what every IBM investor has fantasized over the past decade over. When IBM acquired Red Hat, they acquired that growth, and you can see that it made them, put them into the top 5 cloud providers. You can see the chart there on the right. Now let's talk about constant currency, and this is what we need to understand before we look at how IBM has been doing. Now, the US dollar, measuring that against the strength of other currencies is tricky. So let's take the yen. US dollar, $1 gets you 130 yen right now. That's it used to be 100 several years ago. Is that because the yen weakened or the dollar strengthened? Well, it could be both, right? That extent, measuring the strength of the US dollar, you can't just do that against one currency, as you can see. So you do it against a basket. That's what this chart shows. So the US dollar has gotten quite strong. And this article by the Wall Street Journal here says companies focus on constant currency metrics to soothe investors' nerves as the strong dollar pinches earnings. So I'll give you an example of how that works. Here you can see a number of clothing items. So my belief, and I've read this before somewhere, so it's not my belief, it's one that I stole from others, is that making fewer decisions in your life makes things a lot easier to focus on what matters, and that you should invest in things you use often. So these are clothing items that over the years I've came across and find to be of great value. So that's on the left, there's a McNair jacket. I buy that from the UK. It's the best jacket I believe you can buy. It's merino wool. And these are not cheap items. Again, investing in the things you use often. Those are Joseph Cheney boots there you see in the center. I wear those. I've worn them for years. They're the best boots that you can get, I think, in terms of versatility. And on the right, those are Momotaro jeans. I just bought a pair of those yesterday in Tokyo. And the reason that I bought a pair, I already have several, is because these things are quite cheap. Now, the US dollar is so strong now that it nearly equaled 0.9 British pounds. And when that happened, I bought another pair of those shoes. And prior to that, I had actually bought another jacket because they were so cheap. The dollar actually exceeded the euro in fall of last year. If you happen to be traveling in Europe, things were quite cheap. And it also hit a record against the yen of nearly 150 yen to $1. So if you're somebody that buys things from other countries and the US dollar becomes strong, that's a great time to be buying things because you're giving them less money. Now, the inverse is correct as well. So when IBM sells things to these other countries and they pay IBM in foreign currencies, IBM does those currency transactions, they receive less money when the dollar is strong. So for international businesses, that harms them temporarily because the dollar is not going to be strong forever. So what firms do is they report in constant currency. You have to be careful here, non-GAAP reporting technique. We've warned about non-GAAP. We always focus on GAAP, but sometimes non-GAAP measures are used to show investors certain things. In this case, they're used to show IBM investors that management is now growing the business. So if we forget about the strong dollar and we consider that currency didn't change, what they call constant currency, then IBM software revenues were up 12%, Consulting up 15% and infrastructure up 14%. That is great growth. Now, also, they talk here about incremental sales to Kyndryl. That's the IBM services division that they spun off, which reduced revenues but barely reduced cash flow. So it wasn't a very profitable business. When they spun that out, they gave shareholders shares in that relative to how much IBM stock you held, and we exited those shares. We didn't want to own a business that IBM was divesting. And you can see here where they talk about the transactions that are still happening with that spinoff, where those would have been internal transactions before, but now they're external. And since it's a separate business, they want to make sure that they reflect that growth from part of the business that was divested. And here on the right, you can see that even though they grew these three segments quite strongly, that overall revenues grew in 2022, but not by too much. Now, I wanted to touch on dividend safety because, frankly, we haven't looked at IBM's business for years and years. We focus on one thing for dividend growth stocks. We want to see that dividend paid every quarter, and we want to see it increasing over time. And as long as that happens, we don't care about what's going on with the business. So we take a very simple approach to dividend growth investing. So here's an example of IBM's dividend safety. This was taken from 2019, but these numbers are still relevant. So 2019, they generated nearly $12 billion in free cash flow. All right, so that's the cash the business generated after they paid for operating expenses and capital expenditures. Of that, they returned about half to investors in the form of dividends. That's a lot of wiggle room to continue growing the dividend over time without having to do anything else, without having to grow revenues or to reduce costs, just that wiggle room. Let's say they decide to only grow their dividend by 5% going forward every year because of the uncertainty around the Rona. That's when we wrote this, was around the Rona came up. For those of us who rely on dividends for income, a 5% growth every year is enough to offset inflation, perhaps not now in the United States, but it's still pretty good. If their free cash flow stayed the same at around $11.9 billion, IBM could raise that dividend by 5% for 10 years, after which the payout ratio would then start to approach 80%. That wiggle room is dividend safety. That's the sort of safety we're looking for in a dividend growth stock. Now, this slide here was taken from our Quantigen's dividend growth investing strategy, where we hold 30 DGI stocks. One of them is IBM. Here you can see that ranked against, using our proprietary Q score, ranked against the other two technology firms that fall within this particular industry segment. Couple things to note here. First of all, see that payout ratio being quite low? So we actually penalize them, -1 for the payout ratio. That's because it's very high right now. What that means is because of various reasons we're not going to get into. If you just looked at free cash flow and you just looked at their dividend payout, then they wouldn't be able to cover that, though they have a lot of buffer with debt and whatnot because they're in the process of having a reorganization. And they've also slowed their growth here. You can see that companies that have a 5-year dividend growth below 5% receive a penalty of -1 in our strategy. And there's the aggregate Q score there on the right. That's relatively low compared to a firm like McDonald's, which would probably have a Q score of around 20. Now, the irony is for tech companies that they should be using their profits to fuel continued growth, not handing it back to investors, but IBM's quite a mature company. So, just to conclude on this, IBM's turnaround story seems promising thus far. They seem to be getting some traction on that. As a dividend growth investing stock, the 5.22% yield it's producing is reliable income that we enjoy every quarter while we wait for the company to resume that growth, or let's say consistently resume that growth. Now, some will point to the company's large debt as a potential danger ahead, but if they manage that, then it's just a way. A lot of that came from their acquisition of Red Hat. That's just a way to boost growth using leverage. So I've put up another video here on living off dividends that you might enjoy, but before you click that, please click the Analyze logo here on the right, subscribe to our channel. Thanks so much for taking the time to watch this today.